Welcome and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. In this show, we cover a broad range of topics that both cater to the commercial real estate newcomers and the industry leaders alike, and dig into both the latest trends and most fundamental ideas behind every corner of commercial real estate. I'm your host, Yannis Papadakis, Business Development Manager at Crexi, an all-in-one digital commercial real estate platform designed to empower all commercial real estate buyers, tenants, sellers, and brokers with the tools they need to discover and transact property. As part of that mission, the Crexi Podcast hopes to provide a window into the inner workings of commercial real estate for this generation and the next. Today, we are thrilled to sit down with Paul, Yazbeck, and Jon Krebbs of the Multifamily Group based out of Dallas, Texas. Paul, Yazbeck. Prior to forming the Multifamily Group, Paul was an executive director in investment sales with Sperry Van Ness and finished as the company's seventh highest performing broker out of over 1,100 brokers worldwide in 2017, the highest ranked broker in the Southwest region and the top producer in the office in 2017. In 2016, Paul was the third ranked broker in the Southwest region, was the 25th highest producing broker worldwide, and top producer in the office in 2016. He qualified for the company's Partners Circle recognition in both 2016 and 2017. Paul earned an MBA from the University of Texas at Austin and a BBA in finance from the University of Colorado at Boulder, where he attended an ROTC scholarship. He was awarded the Bronze Star Medal for his service in Iraq during his second deployment as a captain in the Army. Between his two deployments, he spent 27 months in Baghdad from 2003 to 2008. Paul, thank you for your service.
Thanks for having us today.
And Jon Krebbs. Prior to forming the Multifamily Group, Jon was an executive director of investment sales with Sperry Van Ness and finished as the company's 22nd highest performing broker out of over 1,100 brokers worldwide in 2016. Prior to that, he was a top producer at the Henry S. Miller Company in Dallas. Jon specializes in asset valuation, coordination of the marketing process, property tours, and contract negotiation for sellers of multifamily properties. Jon analyzes each assignment carefully and finds creative ways to add value to his clients. When he's not working, Jon enjoys playing golf, playing his guitar, and spending time with his wife, Stacy, and their children, Brad, Jackson, and Finley. Jon is a frequent guest lecturer at Texas Tech University, where he earned his BBA in finance and his MBA. And with that, let's dive in. Gentlemen, thank you so much for joining us today.
Great to be here.
Now, Jon, tell me a little bit about these lectures at Texas Tech. What do you talk about? Do you get flashbacks of your glory days when you go in?
Well, it's funny. I kept waiting there was a guy who'd been there since 1980 who was my professor. I kept waiting and waiting around for him to ask me to come and do this, and finally, I said, I really want to come and speak, and so. I gave a big donation to the school, and they let me come and do that right as he was retiring. So, but it's been great for the company. We actually hired one of our guys from a lecture that I gave there, and I just try to go back every year and give the kids some good advice on how to get their foot in the door in the industry.
You ever, Paul? You ever tag along? You ever come and
I have not yet.
Lecture?
But maybe once COVID passes, we'll be able to travel a little more freely again. I haven't been out there yet.
Right.
But we are active doing deals out in Lubbock with all the guys that are, from Texas Tech at our firm. So it's been good.
Nice. Well, why don't we jump right in and talk about some of the things that have been happening, within your market. And let's first look back into some historical trends happening in the Texas multifamily market. I don't know much about the Texas markets, so why don't you just give me a quick, broad brushstrokes, some, color about the differences in the markets there. Let's go with Houston, Dallas versus San Antonio. What are the regional differences in, multifamily culture, multifamily performance? I'll let you take it from there.
So we just opened up our Houston office this year, and I think we've transacted on 3 or 4 deals there. It certainly was one of the markets that was hit hardest by COVID-19. I think I was looking at the different rent growth for different asset classes earlier today, and Class A was down about 4% negative rent growth from year over year from last year. And even the renters by necessity, which is primarily the business that we're in, what we call B and C class housing, was down slightly in Houston. DFW was the darling of B and C, and renter by necessity housing was up 2.5%, which is down from historically. It's been 3 and 4 and even 5%, but it did really well. And then Class A was flat, and San Antonio has stayed pretty flat. Class A rents dipped a little bit, but workforce housing has remained pretty flat. So all the markets are pretty strong when you look at them compared to the rest of the nation. They're all doing better. Texas markets are than the rest of the United States as a whole. So investors continue to come here. We get calls all the time from coastal buyers, people seeing what's going on in New York, not only with COVID-19, but with the changes in, tax code up there, and also just the rights of landlords.
Right. And
the same can be echoed in California too.
Oh, absolutely. Full disclosure, I'm a multifamily property owner myself. I have 8 units here in Los Angeles, and there's, a lot of navigating I've had to do over the last year of understanding some of these, new policies being put in place, and just trying to, find your footing amidst so much uncertainty, especially when the pandemic first hit. How have collections looked like? Have they been pretty consistent through COVID? Are landlords there feeling a collection crunch?
I feel like for a lot of owners, they've held up pretty well. If people didn't know there was a COVID pandemic in 2020 and still right now, you may not have seen in the numbers at all across all properties that there was a huge dip. It might only be off a few percent. So I don't think in Texas, for a lot of owners, depending on how they operate, they've seen as much of a dip. And on some of the C-class, or by necessity, there have been some groups that are able to get nonprofits to help out with rental payment assistance for some of the lower end properties, and they're helping their residents do that. So that's helped. Obviously, the stimulus checks allowed a lot of residents to keep making their rent payments as well.
Is the growth pullback in Dallas of that A tier? It's still, you're still seeing growth, but it's not as aggressive of growth as you had been seeing. And as you said, in Houston, that A tier has slipped about, what was it, 4%?
That's right.
Is that A tier kind of where you expect to see that first?
Yeah, generally that's where the most competition is, because new units, new properties being leased up, stuff coming out of the ground is constantly being delivered, especially in these larger metros like Dallas, Fort Worth, and Houston. So we do expect them to get, and it was actually, Class A has been flat here in Dallas this year. It was the workforce housing that's up 2.5%, but which is down historically from where it had been, up at 3.5, 4, even 5%. So yeah, to answer your question, Class A is where you expect to see concessions come in as they compete with new product. Right. The 1960s, 1970 vintage apartments that we sell, you don't see any new competition come into those. It's really just economically, how are the residents affected?
And that leads right into my next question here, which is, what trends, were happening in terms of construction, pre-leasing, and pricing shifts, at least, leading up into this, pandemic shift?
I'd say our firm primarily stays in the B and C space, so we don't track A class as closely as we do the B and C. They've said, I've been here in Dallas for the last 7 years, and every year it's, we've been delivering 50,000 units. There's 50,000 units in the pipeline. Everybody's concerned about oversupply, but it's a job creation story here. And as jobs are being created, they've filled in all the apartments that have been delivered. So I think as we continue to see, companies move their headquarters here from California and other
Mhm.
parts of the country, you'll continue to see the supply of apartments to meet the demand.
Right. And how have the fundamentals of the multifamily asset class boosted its desirability to buyers?
I think how, how affected hospitality has been, retail and office. If anything, it makes multifamily much more attractive, probably like industrial assets. They've fared very well during the pandemic. And I think for a lot of groups, institutional money, they can probably look across all their real estate holdings and they can see that their multifamily holdings did much better. I think multifamily has always been boosted by Freddie and Fannie agency financing, and that'll continue to help. I think other sources of debt, like life insurance companies, want to increase their exposure to multifamily financing, so that'll help. And then, we see nothing but positives for multifamily, unfortunately, due to the pandemic, because it just highlights its durability, I think, more than other commercial real estate asset classes.
And I mean, I got to imagine, because I find myself in the same position, when this pandemic first started to hit last March, and there was a lot of unknowns. Your phone must have been blowing up from landlords trying to get guidance on what are the best steps to take. Was there any real concrete advice that you heard from any of your clients in terms of how they were either communicating with their tenants or battening down the hatches to weather the storm for what could potentially be loss in collections or rents falling? Any wisdom or insights there that you'd like to share?
You hit it on the head with batten down the hatches. I've invested in some deals, and they were coming out and telling us that they weren't going to do distributions, capex, projects where they're renovating and spending money. Those were kind of put on hold. So certainly on the expense side, people were trying to conserve everything they could with the amount of uncertainty. And then say the first part of your question again, because I had something for that.
Well, I guess if there's any advice or talk tracks that landlords had shared, or how are they communicating with their tenants to try to put themselves in the best position possible to manage through this?
So you also, I was going to just say that you hit it on the head also with that. Communication was the key. I negotiated the sale of a property in San Antonio the guy had for the last 20 years and had a great manager, but he's, essentially training these residents on how they can go out and apply for this financial aid through San Antonio, the city of San Antonio, and, working with people on setting up payment plans and being flexible and, just continuing to give guidance to his boots on the ground, his management and his maintenance people, how to protect themselves and make their clients, the residents feel safe, but also keep the management office open and keep leasing going. So there was the successful operators really took it upon themselves to over communicate to their staff, to their residents.
And I would say the additional things that helped a lot of owners too would be, there was a round of PPP, and that could be used towards your payroll at your property. So whether it was a management firm applying on behalf of their clients, or whether it was people that self-manage applying on part of their small business, many folks got 2.5 months of payroll forgiven, and so that helped the owners a little bit as well. Some of our clients took advantage of the agency forbearance, and so they had a couple months off, 3 months off of no mortgage payments, and of course once that expired, they're just paying 1/12 of that back each month. And so some didn't need it; they took it because it was offered. But they just were being cautious, not knowing how collections would hold up. I think most of the people that did that, that helped them out kind of weather the storm if they had any, and increase their working capital to be able to, still run their properties properly.
So we're a year into COVID now. What does the multifamily market look like today? Where are we seeing investors looking to buy in terms of, asset classes? Which markets are we seeing, a noticeable shift in preferences of investors due to COVID?
I would say first, I think pricing now on B and C classes higher than, we're still in COVID, but it's higher than before COVID started. It's kind of really been driven by the financing available on, stabilized deals from the agencies. That's really helped pricing out a lot for sellers. So I'd say first and foremost, that's the biggest thing we see. How much longer COVID has an impact on the market, I guess we'll see as the vaccines roll out, but it doesn't seem like buyers they're able to make decisions now, whereas in last spring, last summer, a lot of people were kind of waiting and seeing what was going to happen.
You feel like enough of a pattern has emerged to give at least those that want to be active a level of comfort that they can, go out there and engage in the marketplace.
I would say so. What do you think, John?
Yeah, there's as many buyers as there have ever been. We seem to be getting calls all the time from new groups wanting to buy, multifamily in Texas. I see A properties trading, B properties trading, and C properties trading in all four of the, Texas Triangle markets: Austin, San Antonio, Houston, and Dallas. I think, transactions were obviously down last year. Our transaction volume was down from where we were in 2019, but there was a lot of momentum the second half of the year, and a lot of deals got done. There's people that have raised money and need to deploy it into certain asset. Basically there was a break, and then so when people kind of came around to being more comfortable with buying, a lot of deals started to happen quickly.
And I think some buyers maybe thought there was going to be some opportunity to, get some sort of COVID discount, and we just didn't see it. So those groups that were holding out for that didn't really happen. And now the market pricing is higher than it was prior to COVID, even though not done with it. And so they have to kind of readjust their underwriting, their returns, their IRRs, because that quote unquote COVID discount probably is not going to materialize.
So I've been hearing anecdotally that people are moving away from cities, moving towards suburbs, trying to get out of the, highly densely populated areas. Is that ringing true in any way for you? Are you seeing a larger desirability for more of the suburban markets as opposed to the urban ones?
I do see a lot of desire for, Arlington, these suburbs of, McKinney, down Mansfield. We see a lot of demand for bedroom communities and suburbs. But I think there's a certain number of young people that are always going to want to live in the city. And so we haven't seen a lot of, people moving away from the core here in Dallas. They're still building, we live in the Knox-Henderson area. They just finished a high rise up over here. There's more going up. And it's very much, urban and walkable retail. And I think there's always going to be new young people getting into the workforce that want to live in the action close to uptown and downtown. That's my view. What do you think, Paul?
I would agree with you. I would say from an investment perspective, I think people for a few years now, at least, have been they have to look outside of DFW if they can't compete with other buyers on call for offers or final invest, and the yields aren't there. They've been going to other smaller secondary, tertiary markets in Texas to get where the cap rates may be a little bit higher. So we've been seeing that for a few years, and so we're active in Central Texas. We're active. Just closed a deal in Nacogdoches last week, and we're in a lot of these markets where we can try to help find these buyers the right yield to be able to pay their investors. I think that's been going on for some time now.
Well, the uptick in desirability of these assets, especially in light of how some of the other product types are performing in the face of COVID right now, like hospitality and office, Do owners find themselves wanting to take advantage of their placement and selling now, or are you finding that most of them are deciding, look, I've got something that's super valuable right now, I'm going to hold on to it because where do I reinvest? Where do I put that money in the face of like today's circumstances? Or do you have what everybody wants and now's the time to take advantage of that?
I think it's more the latter. I think I've seen folks that have been holding on to their properties for a very long time, just late last year and this year decide that the time is right to sell. So yeah, they get a lot of calls from brokers and people trying to buy direct, and they know they've got something hot, and they were smart to hold on, 13, 14, 15, 16, 17, 18.
Just watching pricing go up, call volume from brokers going up. And it's like, you got to imagine like right now, if you're looking at your asset type, your product type, pricing is still, inching up. Whereas, all these other ones have just, fallen off a cliff. Like you got to imagine that if you've been thinking about selling, that you're taking a hard look now.
That's right.
Yeah, and I would say a lot of the groups that are active in Texas have a syndication model, and a lot of time their hold time frames are 3 to 5 years. So it's an IRR-driven model, and the longer they hold it, potentially the IRR is going to go down. So if they can exit at returns that make sense for their LPs and themselves, then it might just be a 3-year hold. So they would have purchased the asset in 2017, 2018, just time to sell. And I think they're fortunate that it's a good time to sell because the financing has helped drive pricing. I think one of the things we've been more active in lately is having to do loan assumptions because these people didn't think they would be able to sell yet, but we're having to do loan assumptions because of the yield maintenance. And John could probably kind of dig into that a little bit more.
Well, we've done, I think, 4 loan assumptions in the last 5 months. We've seen prepayment penalties, people paying off $1 million, $1.5 million, $2 million. And sometimes it just makes more sense for the new buyer to assume the loan, even if there's not interest only, even if it's fully amortizing and there's some term on it, even if they have to take a supplemental and put up some of those proceeds that they're borrowing as reserves.
Got it. Interesting. We touched on this really a little bit at the beginning, but more and more people and corporations are leaving New York and California for Texas's tax-friendly policies. What development patterns are you seeing as a result of this? For example, are new multifamily developments starting to include avocado trees for Californians that have to have their avocado toast, daily, right? I know New Yorkers, they love to suffer, so it's some sort of new development patterns are you seeing emerge because of, these new renters that are coming into the market?
I would say because we're focused on B and C class, maybe we don't run into that as much. I know A-class properties have been adding more of the Amazon lockers. I got a call from Amazon about setting up business lockers for the apartments. I think people are talking about more, maybe if people are going to be working from home more, whether the units are going to be larger in the future to accommodate some sort of desk space they maybe didn't have before. And then also maybe some more common work area spaces as an amenity. I would think will be something that developers would be looking at. I'm not sure if we're seeing it in product right now or not, but I can imagine that would be something that would be beneficial.
I do know that at least, multifamily owners here in Los Angeles are looking towards that. My building, it's, what I would probably call C-class. It's 100 years old. It's built in the 20s, the 1920s. And my neighbor next door that bought the property next door to me, pretty much right after I did, gutted the whole thing and did a full, remodel. But there's this weird middle section, right? So I guess back in the 20s, cars could have fit through that little driveway area. Today's car couldn't fit back there. And so he had these little garages that you couldn't access from the street. And so he converted them into little offices. And so he could rent independently or attach to a unit, a little, on-site office space. And at the time when he did it, I was like, oh, it's kind of weird. But what foresight, because all of those people living over there, they've got their office right there on the property. This is way pre-COVID. So I am seeing more amenitization happening on B and C stuff. Are you seeing anything similar to that?
I think what we've been seeing is services and community and people bringing in meals, bringing in programs for kids. It's a little bit different in the B and C space in the type of amenities that they'll bring in. But I've seen a big push for that recently of having doing parties for residents and just really trying to create a sense of community in these workforce housing, rather than, and you still see your bad actors, landlords that, don't put money back into the property and don't care too much for their residents. But a lot of the successful, there are even some for-profit, but they have a mission-driven companies are really trying to give people a better, safer place to live.
Yeah.
And one thing I like for B and C class spaces like community gardens, kind of like you said with your avocado tree comment earlier. I mean, that's something that owners can look into that wouldn't cost that much, but could be a real benefit to their residents.
Yeah, I mean, like I said, I've got a small building here. Right away I rolled my sleeves up and started doing little improvements that I could myself, because I live here too. And I want to make it a nice place for myself to live and the tenants too. So I definitely see. I mean, when COVID started hitting, I was out there disinfecting the doors every day. Printing out and putting information about COVID. The PPP, all that stuff in all my tenants' mailboxes to make sure that they were informed and staying safe. So you do what you can.
I love what you've done with the kitchen, by the way. It looks great. Those
all this
and everything. Yeah, it's awesome.
Suspiciously looks like it could be right out of a West End catalog. Suspiciously. Here's an interesting one, and nobody likes to say the B word, but bubble. Do you anticipate that we're seeing any kind of bubble as a result of this, this large migration into Texas?
I would think because of you follow all the job growth. If you're following, I think it was that we gained almost 375,000 residents last year. I think was the graphic or the figure. As long as there's companies continuing to move here, and some of these, whether it's large ones we hear the headlines of, like Tesla, Charles Schwab, big medical companies. There's also a lot of probably smaller, medium-sized companies that don't hit a lot of those radar but are coming here. But as long as we see that kind of growth in the population and interest rate environments favorable, the returns are there. We're still underwriting deals to 10% cash on cash, 20% IRR on C classes. We're still trying to hit those metrics for these buyers. And so as long as there's still returns there, even though it's maybe driven by financing, but no one's expecting a big spike in rates. John, what do you think?
Well, we are underwriting those metrics you mentioned, but I think we're being pretty aggressive with our assumptions. Whereas, maybe 4 or 5 years ago, we were underwriting the similar metrics, but maybe with, a little bit more realistic assumptions. Realistically today, it's probably, 7-8% cash on cash and maybe a 15-16 IRR, just because it's gotten more competitive and pricing has gone up. And there's just a lot of groups that want to buy deals in DFW and San Antonio and in Houston. But no, I don't think there's any bubble on the horizon. I mean, we had the Black Swan event that everybody talked about. That was COVID-19. And, now we have a bit of a playbook for the next time some sort of a pandemic happens that nobody had before. Right. So I think we'll be able to deal with the next one a little bit better. I don't see fundamentally the underwriters, the lenders are still the numbers still have to work. They're not just giving loans that don't make financial sense. I haven't seen that, so I don't think there's a bubble.
All right. Now with that, let's time to get out your crystal balls. We're going to go into prediction mode. What are some multifamily market predictions you have? And I'll open it up. What do you see in the tea leaves?
I think that there is probably going to be a little bit of a gap in new supply, because probably some projects that didn't get off the ground right in March, April, May, June. And that's going to help the A-class space recover a little bit, that get some of these units absorbed here over the next couple years. And that's going to help with overall rents and overall occupancy for the whole market. We'll be watching carefully. I saw the races, I think, have been called there in Georgia about what happens with, tax policy under the, President-elect Biden, and how much of that he's actually able to get through. Will certainly, impact something. I don't, pretend to know exactly what kind of impact it's going to have, but we will see, some effect from that. The accelerated depreciation, bonus depreciation be phased out. But as long as, Texas keeps doing the things that have made it so successful, the, right to work state, no state income tax, and we kind of continue to try and figure out our property tax policy, we should continue to attract, jobs, and jobs bring people, and be a demand for the apartments that are here and the ones we build in the future.
Yeah, I would say two little minor causes for concern, and John mentioned it briefly, is property taxes in Texas. We'll be interested to see if owners are able to push back on valuations this year, because most owners were not successful in protesting their tax values down for 2020. They got a big bump, and so we'll see if the tax protest companies, we'll see certain counties have some properties valued higher than their actual market value, that maybe weren't increasing taxes for a number of years, and then all of a sudden they started getting more aggressive in recent years. And we'll see if any kind of downturn in property performance will allow them to lower the valuation this year. But I think property taxes are a concern for owners. I think across the board, property insurance has gone up anywhere from 10 to 20%, depending on the vintage and the location. But I think those two things have some small effect on underwriting here in Texas for sure. Maybe not on insurance, probably across the board in other states as well.
And I mean, looking at just kind of the state of the pandemic today, there is a vaccine out there, people are starting to get vaccinated, presumably eventually things are going to get back to normal. And as the workforce returns, to normal work life and the world goes back to normal, do you anticipate demand shifting from multifamily back to other sectors?
Yeah, sure. There will be demand. Sorry, Paul. Demand will come back for retail, for office. I don't think it's going to shift away from multifamily per se, though. I think that multifamily demand from investors is going to continue to increase. But I certainly do think that the other investment types the demand will come back for those. I just don't think it'll detract from multifamily.
If you're thinking of selling, though, something to consider is, while the multifamily core market is still there, today you may have the attention of investors that, maybe don't traditionally look at multifamily, but, now you may have their attention on something. So just something to keep in mind.
Yeah, I think with the pandemic, it probably accelerated changed a lot of businesses' models, and it's probably retail was already getting hurt from e-commerce and Amazons and the different companies that have adapted their business model. And I think the pandemic accelerated the way businesses will operate in the future, and that might have accelerated the downtrend in performance of retail. And we'll see how that bounces back, but it was kind of already happening, and then the pandemic kind of accelerated that.
And we are seeing entrepreneurs, adapt. Retailers are adapting. Sadly, we are seeing a lot of restaurants here in LA close. But we are seeing, a lot of creativity and gumption from those that, aren't going down without a fight. I saw a really nice restaurant on the west side is doing a craft cocktail delivery where you order, literally they send the bartender with like a full bar to your house for, some, appetizers and some cocktails, and it's a package, and it's a pretty penny too, but sitting at home every day, all day, it's nice to have the bar come to you. So I think we'll continue to see more innovation. Now, before here we go. Fifth topic. We're getting close to the end here. What advice would you give investors looking to get involved in the Texas multifamily markets?
I would say, there's a lot of education out there. There's a lot of folks with experience that are willing to share that experience with you for, sometimes it costs money. So there's a lot of stuff that's meetups and information that's out there for free. You have to search for it, but it's out there. There's a lot of good data that's out there for people that want to be in the space. And you are going to have to be willing to give up some piece of the deal, I think, to get your foot in the door. Unless somebody's just already, pretty wealthy, they're going to have to bring in some partners with some experience and, piggyback off of the experience in order to get the debt and possibly raise the equity. But there's nothing wrong with that, because once you can start to develop a track record, if you're willing to work really hard, like a lot of these people I've seen be successful are, then there's room enough for everybody.
What advice would you give your fellow brokers working in the sector? Quit it?
No, I give advice every day. I give unsolicited advice. Some people call it criticism, but I give unsolicited advice every day to the brokers that work here in TMG. And I think that what advice I give other brokers is give Paul and I a call about, opening up a multifamily group office, maybe in another city, or if, you feel like maybe the deal you've struck that you thought was a good deal when you struck it is not so much anymore. Give us a call and we might be able to work together.
Yeah, we actually grew a lot during the pandemic, adding a lot of talented brokers, and we're up to 13 now. And so the downturn during certain parts of last year allowed folks that maybe didn't have the right timing to make a move, because there was a little bit of a slowdown. They could jump ship and maybe not hurt them as much financially. So it was a good opportunity to grow and add some good brokers, and maybe it's a possibility to add some more in 2021, certain parts of the year. Yeah. For you, Yannis, you can sell your 8-unit deal in LA and come buy 100 units in Texas. That's a very common story.
I'd be lying if I didn't say I haven't been looking at real estate in Texas more and more over the past few months. So who knows? It might be in the cards. Actually, I have a good friend of mine from college that's in Houston, and I'm supposed to go visit him. And I may come and knock, and you can show me some real Texas barbecue.
You keep this beautiful unit maybe post sale, and then you could have a nice asset in Texas.
Absolutely. Okay. Any final thoughts on the state of multifamily in Texas? Anything that we didn't touch on that you feel like is important that you want to share?
Well, make sure you sign up for Crexi and all of the content, and all of our deals we post on Crexi. You can go in there, you can sign a confidentiality agreement, you can download the trailing 12 months of income and expenses, you can download the rent roll offering memorandum, and you can start to look at deals and familiarize yourself. I'm talking with more about the folks you said that might be interested in getting into the business, and start to familiarize yourself with the vocabulary and some of the things that you'll see in those. And and then, give us a call. We're happy to help, people learn about the properties we're selling, and anxious to give tours and sell the deal.
Awesome. And I have to ask, Jon, guitar, acoustic or electric?
I play an acoustic. I like the electric, but I don't have one.
Do you shred on it? What do you play? What's your what are your go-tos?
There's actually a video of me playing a song I wrote. I tried to win a Don't Mess with Texas contest for, that's our slogan about an anti-littering campaign.
Nice.
It still is out there on the internet somewhere.
I'm going to hunt it down.
I like Dave Matthews is probably my favorite acoustic guitar player. I think he's the most talented singer-songwriter. With just him and an acoustic guitar is probably the best.
That is a brotastic choice. Dave Matthews, fantastic. I've never been to Texas. I've always wanted to go. My only experience with Texas comes from the hit Fox animated series King of the Hill. And I've always wanted to go ever since watching King of the Hill. I thought it was hilarious. Is it accurate? Is it culturally accurate?
Maybe in some smaller, maybe in some smaller towns, I think it certainly is. There's, you'll definitely hear some accents, and see some rednecks, here in Texas. There's no question about that.
So I got to know, charcoal or propane, which is the proper way to barbecue?
I cook on charcoal.
Paul?
My grill's gas.
Oh, wow. Okay. So, I mean, you guys have to do like team barbecues, who's the grill master when that happens?
We both moved into new houses in 2020, right before the pandemic. So we haven't had any housewarming parties or had guys from the company over yet. No poker games, nothing. So hopefully once this all winds down.
Well, drop me a line when it happens, because I want to come and taste some of that barbecue too.
We'll do it.
Definitely. You should visit Austin too. I think it's a good place.
Will do.
A lot of Californians like Austin.
Awesome. Well, gentlemen, thank you for joining us. It's always great to hear your insights, especially on such a timely and important topics. We really appreciate your time today. I know you're both very busy, so thank you for taking the time this morning to sit down with us. Where can people find you online if they want to get in touch? Can you guys plug your social medias and give your emails?
Yeah, multifamilygrp.com is our website, and our phone numbers and emails are on there, contact forms, deals, links to Crexi, everything you could ask for, multifamilygrp.com.
Awesome. And thanks to everyone who tuned in today. If you enjoyed this episode, be sure not to miss the next one. Visit go.crexi.com/podcast and sign up to get the very next episode delivered straight to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app and check out our YouTube channel for video recordings of each episode. That's go.crexi.com/podcast. Goodbye, stay well, and be sure to tune in next time.